And those are some of the headlines. This is Democracy Now!, democracynow.org, The War and Peace Report. I'm Amy Goodman with Juan Gonzalez.
And welcome to all of our listeners and viewers around the country and around the world. We begin today's show on the landmark settlement between Wall Street giant Goldman Sachs and the Securities and Exchange Commission. On Thursday, Goldman Sachs agreed to pay $550 million to resolve a civil fraud lawsuit over selling a mortgage investment that was established to fail. The investment consisted of pools of risky mortgages that had been packaged together. According to the SEC, the pools were picked by another Goldman client, John Paulson, who was betting against their success. Robert Khuzami, the director of the Division of Enforcement at the SEC, announced the settlement.
Today's settlement is a stark reminder, a very stark reminder, that there will be a heavy price to be paid if firms violate the principles fundamental to the securities laws: full disclosure, honest treatment, and fair dealing. And those principles do not change regardless of how complex the product or how sophisticated the investor.
While the SEC hailed the $550 million settlement as the largest in Wall Street history, many outside analysts question why the government didn't demand more. Press reports indicate Goldman Sachs expected to pay at least $1 billion to settle the case. For Goldman Sachs, $550 million is equivalent to how much Goldman made every 2 weeks in the first quarter. The penalty is only 1/20th of the $10 billion in bonuses the firm handed out last year. Investors responded favorably to the settlement as Goldman Sachs shares jumped by 5% in late trading, adding far more to the firm's market value than the amount it'll have to pay in the settlement. To talk more about Goldman Sachs, we're joined by Matt Taibbi, a reporter with Rolling Stone. Last year, he published a widely read article about Goldman called The Great American Bubble Machine. Welcome to Democracy Now!, Matt.
Good morning, Amy.
First, your response to this settlement.
Obviously it's the biggest settlement in SEC history, and people shouldn't overlook the fact that since the suit was announced, Goldman has lost about $25 billion in share value. However, it's smaller than everybody expected. I mean, the people that I've been talking to in the last few weeks, the number everybody thought was the baseline was $1 billion. And, you know, the fact that it's only $550 million, I think, was seen on Wall Street as being a light penalty.
Now, the firm obviously admits no wrongdoing in this case, and obviously its share price is beginning to rebound immediately after the settlement. Your sense of how the administration decided to settle this?
Well, you know, originally Goldman didn't want to settle, so the fact that it was settled at all is interesting. But, you know, this is sort of part of a larger pattern of how, you know, offenses are dealt with by, you know, our regulatory enforcement mechanisms. You know, going back, you know, 20 years, almost every time we have an instance where a very powerful bank is caught doing something, you know, unethical or immoral, the procedure tends to be a fine, which is much less than the profits they generated using that activity, followed by no admission of criminal wrongdoing, and of course nobody ever goes to jail. And the most famous example of that was the so-called global settlement after the internet stock bubble, in which, you know, a variety of offenses involved with the tech bubble were sort of lumped together by then Attorney General Spitzer. And although some companies took a big hit, Citigroup had to pay $400 million, it was much less than all these guys made during the stock bubble. And so the important fact here is that these companies know that even if they get caught, the worst case scenario, they're going to pay a fraction of the money they make doing this stuff, and that's why they're continually emboldened to do it.
I mean, it is stunning, as the Times put it. News of the settlement sent Goldman shares 5% higher in after-hours trading, adding far more to the firm's market value than the amount it will have to pay in the settlement. So right. It profited from the settlement.
Yeah, absolutely. And, you know, overall, the stock market itself was up, I think, 4.5% yesterday. So there was a general sense on Wall Street. There was apprehension about what the settlement might be. If it turned out to be much bigger than expected, I think there was going to be fear that, you know, there might be more prosecutions. But I think this was a message that there's an attempt by the government to really put this all behind us, that this is going to be sort of the exclamation point in the financial crisis era. And there's a belief on Wall Street that this is it, that they're going to move forward now, and there's no more worrying about the government looking over their shoulder.
Well, I was struck in the article that you had last year in Rolling Stone in terms of the history of Goldman Sachs, which most Americans don't know anything about. And
right.
you clearly document how Goldman has repeatedly been involved in creations of speculative bubbles on Wall Street, and always seems to walk away and then just make more money in the next bubble. Could you talk about some of that history and the actual how this firm got to be where it is now?
Well, I mean, Goldman has an extraordinary history. You know, we chose Goldman Sachs because it was representative of everything that investment banks in general were into for the last 20 years, but also because it was a special case, because Goldman is politically connected in a way that no other company in America really is. And they've had a hand really in a variety of financial disasters over the last 2 decades. During the internet stock bubble, they were the #1 bank in terms of initial public offerings of internet companies. Remember that whole period where, you know, teenagers were putting ideas on the back of napkins and they were being taken public, you know, within 5 minutes after that. I mean, all that fraudulent and crazy Ponzi scheme of the internet stock bubble, Goldman was right at the forefront of that. They were a major player in the mortgage housing bubble in the middle part of the last decade. And, of course, the commodities bubble, which your next guest is going to be talking about. Goldman was a major player in commodities speculation. So they're right there in the middle of all these speculative bubbles. And again, an important thing to remember is they continually walk away with fines and no admission of criminal wrongdoing, which emboldens the company to continually get into these schemes.
Matt Taibbi, just to be clear, the firm did not have to admit any wrongdoing.
Right.
They just said that it was a mistake that the marketing materials on a subprime mortgage product that a Goldman client helped craft had not been clearer.
Yeah, they were
They're
incomplete,
talking about John A. Paulson.
Right.
Explain how the whole deal worked and who this hedge fund manager was.
Okay, here's the deal. You have a hedge fund manager, this guy John Paulson, and he looks at the entire subprime market and he sees that the whole thing is going to collapse because people who should not be getting big houses are getting houses. You know, the rating system is completely off. Instruments that should have been subprime are rated AAA. He goes to Goldman Sachs and he says, I want to bet against this stuff. Can you make a deal full of, you know, credit default swaps, or, you know, a synthetic credit default swap full of subprime referenced entities that I can bet against? So Goldman then hires a company called ACA, which is like a middleman, and their job is to basically pick the mortgages in the deal. But Goldman says to ACA, we'd like you to have this guy, John Paulson, pick the stuff that's in the deal. Now, ACA thought that Paulson was betting on this stuff and not against it. And the people they ended up selling this material to were not aware that a person who was betting against this material had chosen the material in the deal. And so, you know, when you're selling somebody this stuff and they think that the people who chose it are long when they're actually short, well, that's, you know, to say that they just overlooked it and they forgot to include that fact is, you know, it's a major, major omission.
And this, you said before that Goldman Sachs originally wanted to go to trial, but it wasn't there the potential that a trial would bring out much more information especially under oath,
sure,
than so far has come out in public, and that therefore they avoided exposing the inner workings of the company as a result of the settlement.
Absolutely. You know, had this gone forward, had there been discovery, had there been public testimony, we would have, you know, among other things, the public would have learned an awful lot about what, you know, how these deals work. But we never ever find out about this stuff. I mean, that's a long-running theme of this. You know, if you defraud somebody, just somebody off the street, if you're a con man and you defraud somebody out of, you know, $1,000, $50,000, you're going to go to jail. I mean, it's not like you know, you're going to have to pay the money back and you can walk on your merry way. That's not the way it works. But in Wall Street, if you commit a massive crime, if you steal not $1,000 but $1 billion, you get to walk away from it, you get to give a little bit of the money back, and then you get to walk away, and nobody goes to jail, and nobody ever hears about it.
So let's talk about who's in Washington, who's in the Obama administration from Goldman Sachs.
Well, the number 2 guy at the Treasury, Mark Patterson, is a former Goldman Sachs employee. You know, there are people in the Obama administration who are very close to Robert Rubin, who used to be a head of Goldman Sachs. Timothy Geithner is a former Rubin aide, and he's the head of the Treasury. The head of the Commodity Futures Trading Commission, Gary Gensler, they're the people who regulate commodities. He's a former Goldman Sachs banker, although it must be said,